On Friday, May 29th, the Indian stock market experienced a sudden, violent plunge. By the closing bell, the Sensex had dropped over 1,000 points, erasing roughly 5 lakh crore rupees in total investor wealth in a matter of hours. The epicenter of this financial shockwave was right here at the Bombay Stock Exchange. This chart shows exactly what caused the damage. Foreign institutional investors, or FIIs, pulled out a staggering 20,637 crore rupees in a single trading session. That is an enormous departure from normal daily trading averages. But that Friday was actually the climax of a much larger trend. For 11 straight months, foreign capital had been leaving the country, culminating in nearly 56,000 crore rupees offloaded in May alone. A single-day outflow of 20,000 crore creates a systemic vulnerability. When capital exits a market that quickly, it drains the baseline liquidity that allows large financial institutions to operate smoothly. The immediate casualty of this capital flight is the Indian rupee. To pull their money out of the country, foreign investors have to sell their rupee holdings to buy US dollars. That massive sell-off directly weakens the currency's exchange rate. That currency stress bleeds into domestic liquidity. With less cash circulating in the system, borrowing becomes more expensive. This directly increases the funding costs for traditional banks and NBFCs, non-banking financial companies, which are institutions that offer loans and credit without a traditional banking license. At the same time, relentless foreign selling artificially suppresses the valuations of India's most successful large-cap companies. No matter how strong their quarterly earnings are, heavy sell-offs keep a ceiling on their stock prices. A depreciating currency, expensive credit, and stagnant stock prices form a dangerous feedback loop. Arresting this capital flight is required to prevent these financial pressures from slowing down the actual physical economy. This graph illustrates the primary magnet pulling money away. U.S. 10-year Treasury yields are nearing 5%, levels unseen since 2008. With virtually risk-free U.S. returns waiting, foreign managers have little incentive to navigate higher volatility in emerging markets like India. Now add a geopolitical accelerant. The escalating conflict in West Asia has driven up the price of Brent crude oil. Because India imports a massive share of its energy, expensive oil threatens to heavily inflate the national import bill. Currently, the stability of those oil prices hinges entirely on an unratified ceasefire arrangement between the U.S. and Iran, a deal still requiring final presidential approval. And while U.S. leadership states negotiators are close to an agreement, global institutional investors remain highly cautious in the absence of a formal signed confirmation. You have guaranteed high-yield returns waiting in the United States, and the unpredictable threat of a global oil shock hanging over India. That combination creates the perfect macroeconomic environment for foreign capital to pack up and leave. But the slow exit became a flash crash on May 29th due to a technical trigger, the rebalancing of the MSCI Standard Index, a major global benchmark that passive funds use to decide what stocks to hold. This flowchart demonstrates the index logic. When a stock is excluded during an MSCI review, passive global funds are mathematically required to sell. Instantly, high-frequency trading algorithms detect this forced selling, executing thousands of micro-trades that supercharge the downward momentum. When algorithmic trading detects forced index rebalancing sales, it strips away the market's natural price discovery. The selling feeds on itself, creating a mechanical crash completely disconnected from the actual financial health of the companies being sold. If you only look at foreign capital, the picture is bleak. But there was a massive counterforce operating in the background: domestic institutional investors, DIIs. As we can see in this area chart, while foreign investors offloaded 55,000 crore rupees in May, domestic investors injected a staggering 82,668 crore. They bought stocks every single day of the week, acting as the ultimate market shock absorber. By absorbing the foreign selling pressure, domestic institutions successfully decoupled the Indian market from its traditional reliance on foreign capital. They held the floor. However, a defensive holding action is not a long-term growth strategy. An economy targeting massive, rapid expansion requires a constant influx of new capital. It cannot sustain high growth rates relying purely on the optimism of domestic retail and institutional buyers. This leaves the incoming government with a critical policy question. To offset the gravitational pull of those 5% U.S. yields, will they need to introduce aggressive tax incentives? Slashing the long-term capital gains tax, the LTCG, is currently viewed by analysts as the most powerful lever available. Lowering the tax burden on profits directly increases the net return for foreign investors, making Indian equities highly competitive again. The domestic capital pool provided a vital shield during the May exodus, but to actually win back the global capital required for the next decade of growth, India will likely have to restructure its tax environment and go on the offensive.